If you just started freelancing, driving for Uber, delivering for DoorDash, or you got your first 1099 in January and you nearly had a heart attack looking at what you owe, this video is going to explain exactly why that happened. Because here is something that nobody tells you when you leave a traditional job or start earning gig income. When you work a regular job, your employer pays half of your Social Security and Medicare taxes for you. It comes out of their pocket. You never even see it. But the moment you become a gig worker or freelancer, you are the employer and the employee, which means you pay both halves, all of it, yourself. That is called the self-employment tax. And today I am going to break down exactly what it is, exactly how much you owe, and most importantly, 3 completely legal ways to reduce it. Welcome to Gig Money Guide. Let's get into it. Let's start with the basics. The self-employment tax is not a punishment. It is not the IRS being unfair to gig workers. It is actually the same tax that every working person pays, Social Security and Medicare, also called FICA taxes. The difference is how it gets paid. If you have a traditional job, your employer takes 7.65% out of your paycheck every 2 weeks. Then your employer matches that and pays another 7.65% on top directly to the government. You pay 7.65%, they pay 7.65%, total 15.3%. Now, here is what happens when you are self-employed. There is no employer, so you pay both sides, the employee half and the employer half. 7.65 plus 7.65. That is the full 15.3% self-employment tax. Now, I know what you are thinking. 15.3% on top of my regular income tax? That is brutal. And you are right, it is a significant number. But once you understand it, you can plan for it. And once you plan for it, it stops being a surprise. Here is what makes up that 15.3%. 12.4% goes to Social Security on earnings up to the yearly limit. 2.9% goes to Medicare on all earnings with no cap. Total 15.3% on your net self-employment income. Now let's talk real numbers, because the 15.3% sounds scary, but it is actually calculated on your net self-employment income, not your gross income. Here is how it works. First, take your total self-employment income for the year. Let's say you earned $50,000. Next, multiply that by 92.35%. This adjustment exists because employees only pay half of these taxes, so your taxable amount is slightly reduced. So $50,000 becomes $46,175. Then multiply that number by 15.3%. That gives you $7,065. That is your self-employment tax, $7,065. And that is on top of your regular income tax. Now, here is some good news. You can deduct half of your self-employment tax from your taxable income. So from that $7,065, you can deduct $3,532 before calculating your income tax. It does not eliminate the tax, but it softens the impact, and it happens automatically when you file. Now, a quick note for higher earners. If your income goes above $200,000 as a single filer, or $250,000 if married filing jointly, there is an additional 0.9% Medicare tax on the amount above that threshold. If you are just starting out, you probably won't hit this yet, but it is something to keep in mind as your income grows. Now, let's get to the part most people care about, how to reduce this tax. You cannot eliminate self-employment tax completely, but there are legal ways to reduce how much you actually pay. First, maximize your business deductions. Self-employment tax is calculated on your net income, meaning your income after expenses. So every legitimate business expense you write off reduces both your income tax and your self-employment tax. That includes mileage, phone bills, home office expenses, software subscriptions, and equipment. Every deduction lowers the amount your tax is based on. Second, contribute to a retirement account. Options like an SEP-IRA or solo 401k reduce your taxable income. While they do not directly reduce self-employment tax, they lower your overall tax burden and help you keep more money. If you are not using one of these as a gig worker, you are likely overpaying in taxes. Third, consider an S-Corporation election. This is more advanced and generally makes sense once you are consistently earning around $50,000 to $60,000 or more. With an S-Corp, you pay yourself a salary and only that salary is subject to self-employment tax. The remaining income can be taken as distributions, which are not subject to that tax. This can save you thousands, but it comes with rules and costs, so you should speak with a professional before choosing this route. Now, here is what you should do next. First, estimate your self-employment tax. Take your expected annual income, multiply it by 92.35%, then multiply by 15.3%. That gives you a rough estimate of what you owe. Second, start tracking every business expense, every mile, every subscription, every piece of equipment. These directly reduce your tax. Third, open a separate savings account just for taxes. Every time you get paid, move 25 to 30% into that account and do not touch it. Fourth, learn about quarterly estimated taxes. Because you are expected to pay throughout the year, not just once in April, missing those payments can lead to penalties. The self-employment tax is one of the biggest financial surprises for new gig workers. But now you understand it. You know what it is, how it works, and how to reduce it legally. If this helped you, subscribe to Gig Money Guide. Every week, we break down financial topics specifically for freelancers and gig workers, the things traditional finance channels do not cover. Next, learn how quarterly estimated taxes work and exactly how much you should be paying throughout the year. I'll see you in the next video.